Republicans and this group did not want to go along with many of my family plan issues, the child care tax credits, the human infrastructure that I talk about.
We will get this done. It's a very, very good moment for America.
I love capitalism, but I always believe that you need to put some guards around it when it comes to ensuring capitalism works.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, the Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. We have a deal. President Biden reaches a bipartisan infrastructure agreement worth over $500 billion. EU leaders reject calls to hold formal talks with Vladimir Putin, a rare public defeat for Angela Merkel at what could be her last summit. Well, we'll speak exclusively with the Irish Finance Minister, Paschal Donohoe, shortly. And Wall Street's biggest lenders sail through the Fed's stress tests, setting the stage for a bumper bank buyback and dividends. Now let's get straight to our top story. And Joe Biden's determination to forge a bipartisan infrastructure deals is paying off as a group of Democratic and Republican senators reached agreement on a $579 billion plan. Now, joining us to discuss all of this is our D.C. morning editor. She's Kathleen Hunter. Hi, Kathleen. So what are the challenges now that this agreement, that it faces in Congress?
Well, the challenges are really myriad. It was a big day for Biden yesterday in terms of being able to stand in front of the White House, flanked by Republicans and Democrats, and basically claim that he did what he said on Inauguration Day he was going to do, which is find compromise among both parties. Now, that being said, this is where the hard work really begins. Many conservative Republicans are saying they plan to fight the plan, and liberals are demanding assurances that an even larger spending bill, one that Democrats are looking to ram through without new Republican backing, will also pass as a condition of their support. And so really getting this through Congress is going to be very, very tricky going forward. And this deal is, while this is a significant step forward for it, it's nowhere near at the finish line yet.
So how much of an important political win, though, is it for Biden, regardless of the final outcome?
Well, it certainly is significant. He came into office saying he wanted to govern for all Americans. This has really been his priority, getting this economic spending through. He's tied it to the coronavirus pandemic. So along with getting vaccines in the arms of Americans, this has really been his top priority. And so, being able to get a bitterly divided Washington, and in a bitterly divided Washington, being able to get even any Republican backing for a deal of this size, as he said, more than half $1 trillion, getting any kind of Republican backing for this is a significant step, and certainly one that I think Biden and his fellow centrist Democrats will point to in the midterm elections that are coming up quickly in November of 2022. They're going to certainly point to this, whatever the outcome, as a significant indication of their ability to govern for the American people. And so I think even if it doesn't go through, they're going to point to this as a win and say, look, we tried. It's Republicans that caused the problem. And if they do get it through, then they're certainly going to point to it as an accomplishment. So much like the Trump tax cuts of a few years ago, I think this is kind of a winning issue now, or one that Democrats see as a winning issue politically in the midterms, no matter what the outcome ends up being.
Kathleen, thank you so much. Our D.C. morning editor there, Kathleen Hunter. Now, the race is on to save the summer. A vaccination campaign gathers pace around the world. More and more travel markets are returning to pre-COVID levels. That bodes well for the pandemic-ravaged aviation and tourism industries. But where exactly is seeing the sharpest recovery, and where, more importantly, is it safe to fly to? Well, to answer both those questions and more is our Benedict Kamel. He's Bloomberg's senior editor in Berlin. Benny, thank you so much for joining us. Which markets have actually seen business come back already?
So we've seen a recovery in some markets like Russia, neighboring Ukraine is doing much better than it was previously, Mexico, Costa Rica, and so on. And across Europe, really, we've seen a gradual recovery. This is part of our weekly flight tracker that we put out, and we look at sort of where we can see pockets of recovery. And what we're seeing now is that it's more widespread, that it's really gaining traction. A lot of that, obviously, as you said, has to do with the vaccination campaigns that are gaining speed. speed. Conversely, we are seeing some markets slip back a bit. The UK still remains somewhat stuck because of the Delta variant there. We've seen in China, for instance, some areas of China where there have been local outbreaks. Those have slipped again. So it's this sort of in and out that we're seeing. But broadly speaking, we are seeing this recovery, and that, as you say, bodes well for the summer travel, or at least the tail end of that.
So, Benny, what's the latest on the UK with its overhaul of the traffic light system?
So we have the traffic light system, as you said, and last night the government came out and added a bunch of hot tourism destinations to that list. So we have the Balearic Islands, we have parts of the Caribbean that have been added to this. So this is good news for people who do want to get onto the beaches. Conversely, they did also add some countries to the red list, which is essentially a no-go area. You have to go into lengthy quarantines, you need tests and so on. So there are some markets that have been added to that. The feedback from the aviation industry in particular has been, this is a good sign, but it's not enough, it's not fast enough. They're trying now to pump more capacity into these markets, but the question really is, will it be enough for them to really get some of the money back that they've lost in the better part of the last year?
Great. Thank you so much, our Benedict Campbell there with the very latest on some of these travel restrictions and certainly also some of the easing. Now, with its 12.5% corporate tax regime, Ireland may have a lot to lose from the G7's push for a 15% minimum global rate. Up next, we'll ask the man in charge of Irish finances. Don't miss our exclusive interview with Paschal Donohoe. He's Ireland's finance minister and your group president. If you have any questions or comments for him, just IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it was earlier this month when the US, the UK and other leading nations agreed to back a minimum global tax rate of at least 15%. The G7 also wants firms to pay more tax where they sell goods and services rather than just in the countries where they book profits. Well, one of those countries is Ireland. With its 12.5% tax rate, it has long been an attractive destination for foreign multinationals. If the group of seven gets its way, how will this affect revenues in low-tax countries? Well, let's find out. Our Brussels correspondent, Maria Tadeo, is standing by with the Irish finance minister, and I'm very excited about this interview. Maria, take it away.
Thank you so much, Francine. And yes, we are joined by Paschal Donohoe, who is the Irish finance minister, but also head of the Eurogroup. And we're back in this building for the first time in a year, so it does feel like a special moment. And Minister, how are you?
I'm great. How are you?
We're back here. We're in person, and it does seem that this is a real testament of the European recovery. The fact we're reopening.
Well, what's great to see, not just in Brussels, but obviously in cities all over Europe, is we're seeing the return of people. We're seeing cities reopening. We're seeing our restaurants and offices begin to get that busier. So, yeah, many signs of progress at the moment.
Are being made. And, I know you're keen, first of all, to speak about this recovery. But, there's a real debate as to what's going to happen with the fiscal policy now that the economy is actually improving. What is the risk that we pull out fiscal stimulus too quickly?
Well, where we are at the moment is, I believe, we're in the early phase of a very strong rebound for the euro area and for many different national economies. And as you'll know, the European Commission are indicating that we'll have growth now for this year and next year well in excess of 4%. But that being said, a rebound is not the same thing as a recovery. We've much harm we need to heal. We've many people we need to get back to work. We have many people whose income has fallen by so much. So for all of those reasons, for next year, the Eurogroup has already agreed that we will have a supportive budgetary stance within the euro area. And that, combined with the implementation of the recovery fund for Europe, I think will manage the risk that you've raised.
And, yesterday, in terms of the variants, we know the European leaders said they are concerned, and there's a real debate between how much we should protect ourselves from the spread and how much we should reopen. How big a risk is that for the European economy, the fact we fall back into a new wave?
So it is a risk. And tragically and unfortunately, we've all had to confront this risk on so many occasions in our very, very recent past. But what is so different now versus where we were even at the start of this year is the amount of vaccination that has now occurred within the European Union. Half of our citizens have received at least a vaccination. So while that risk is there, I think the impact of that risk is different to where we have been at other points. But what we need to do for now is monitor it, and in particular monitor how it is spreading and take careful decisions as we understand that more.
And, you know, this is slightly on the politics, and I know you like to look at the numbers, but on that note, do you feel the European strategy has been vindicated to some extent? Europe took a lot of heat at the start of the year.
I think we can make the case for how our efforts are working. We have been engaged in this extraordinarily long contest with this pandemic already, and we're only 15, 16, 17 months into it. And some parts of that contest will go well, others are more challenging. But if I look at where we are now, if I look at how we are seeing our economies begin to recover, I think we can make the case that our economic measures have been successful. And if I look at our vaccination strategy, I think I can credibly make the case that we're now catching up and we're really accelerating. But all that being said, even though I might make that case to you, we can't be complacent about the future, either from an economic or public health point of view.
And, you know, when investors look at Europe and globally, the conversation is very much on inflation. This is really the top line for investors. Will we see a pickup in inflation, and just how systemic is it? Do you worry about inflation overshooting in Europe?
It is not, for me, the same kind of economic risk that the risks of low growth, low employment and low income growth could be. Our central bank have indicated very clearly, and I believe they're right, that we should expect, and we are seeing, some signs of inflation growth. And much of that is due to where we are with supply chains, pent-up savings. But equally, I believe, by the time we get to 2023, we will begin to see inflation rates within the euro area converge back to what we would expect. So, as with everything, we need to monitor it carefully. But if I look at the hierarchy of issues that we have at the moment, there are other things that we really have to focus on.
And, you know, of course, you wear two hats. You're the head of the Eurogroup, and also you're a finance minister for Ireland. You have to combine the two. There's a big summit coming up at the G20, which, of course, focuses on that digital tax reform. Do you expect this to be the breakthrough that markets are positioned for, that something meaningful comes out?
So, speaking as finance minister for Ireland, yes, I believe that during the year there will be an agreement reached on this issue. I believe what we will see is a sequence of meetings that lead to a comprehensive agreement in the second half of this year. And yes, the G20 meeting in Venice will be one of those signposts to getting to that point. And yes, that is going to pose some challenges for Ireland. But we do believe an agreement is needed. And if I look at what those challenges are, I'm very confident that Ireland can still be competitive and still contribute to a good global agreement on these matters.
Right. And you know, when investors look at the Irish economy and they may say, wow, this could be a real shock to the Irish economy, is that overblown, perhaps, the concerns?
I'd make the case that we're well prepared for this. So since the end of 2019, I've already been factoring into our tax revenues for the next number of years a loss in corporate tax revenue due to the potential of an overall agreement. And even with that loss of tax revenue, our national finance has still moved to a position of balance in the coming years. And from an employment point of view, you know, no country can ever be complacent about the employment or the investment that it has, either through international means or through domestic investment. That being said, though, so much of the investment that we have had in Ireland now we've had for decades. We have a domestic economy that's so much stronger than it was a decade ago. So while I recognise there are challenges, I'm equally confident we can overcome them.
Right, and that is undeniable. There's been a huge turnaround in the Irish economy from the crisis to now, so that is clearly there to be seen. I just have to ask you, you know, you're Irish, I do have to ask you this question on Brexit. We did see there's a truce on the famous or the infamous sausage wars. It does seem that the relationship perhaps is improving to some extent, but there's still many challenges. How worried are you about the lack of implementation on this?
So Brexit is a process. It is going to be ongoing. It is going to be an enduring and permanent feature between the relationship of the United Kingdom, the European Union and Ireland. While there is I believe, some signs of a shift in tone regarding where we are at the moment, we do need to implement the protocol that was agreed between the European Union and the United Kingdom. The protocol is a way of managing disruption. It's not the cause of disruption. And the European Union will work as hard as it can to find areas of flexibility and compromise and imagination within that structure. But it is a critical part of our agreement. I want a really positive relationship between the EU and the United Kingdom. We've far more in common than we have that separates us. But part of how we need to get to that point is implementing what we've agreed.
And Minister, I want to ask you to put back your hat of Eurogroup head. We've seen the ECB very aggressive, to support this economy. The Recovery Fund being very successful so far. But some would argue there's still a pillar that's missing here, and that is the completion of the banking union, to see very strong, united European banks across the region. When are we going to get something that's fully meaningful?
So we have made progress in many elements of banking union. If you look at where we are from a regulatory, supervisory point of view, huge progress. If you look at how we've strengthened our safety nets even recently in November, again, big progress. But it is a fair critique. And we're working very, very hard to try to agree a roadmap, a work programme regarding how we can make progress on the outstanding elements of banking union. I hoped we were going to get there in a recent Eurogroup meeting. We didn't. And we're going to return to that with renewed enthusiasm and determination later on in the year. And I hope reach agreement at that point with a sequence then of initiatives across 2023 and 24.
Well, Paschal Donohoe, thank you so much for coming on Bloomberg Surveillance. We always appreciate your time.
Great to be on. Thank you very much.
And Francine, well, it's not just the politics, it's also the economics. And we're expecting also to hear today from Christine Lagarde on the European recovery.
Yeah, thank you so much, Maria Tadeo there in Brussels with a great conversation with the Irish Finance Minister and your group president. Of course, the conversation today will also be on vaccinations and travel within Europe and between Europe and the UK. Coming up, Wall Street's biggest banks have cleared the Fed's stress tests and regulators are looking at the collapse of ARCHEGOS. We get the latest next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Wall Street's biggest banks have easily cleared the Fed stress tests and will be free from restrictions on dividends and share buybacks that were put in place last year. Meanwhile, the Antitrust Unit of the U.S. Justice Department is said to be examining how global banks handled multi-billion-dollar trades with collapsed hedge fund ARCHEGOS Capital Management. Well, joining us now is Bloomberg's finance managing editor for EMEA. He's Michael Moore. Michael, I have like a million questions, so we need to go fast. First of all, what can shareholders actually expect from U.S. banks post-stress test?
Well, we get the actual numbers on Monday, but you can expect a huge increase in dividends and buybacks from what was an artificially depressed levels because of the pandemic. So this is back to paying out a huge amount of profits.
I mean, in total, it's like 6 big banks,
yes,
possibly paying out $140 billion.
Yes.
I mean, it's a big number.
Yes, yeah. Well, they managed to stay very profitable during the pandemic because of the trading boom. And now they have more than a year kind of pent up capital that they're wanting to get back.
So what does it mean for European banks? Do they just get left in the dust again?
Well, that's why European banks have been kind of pushing the regulators here to lift those restrictions as well. You know, the case is, well, why would somebody invest in a European bank if they can't get, access to those capital payouts? And that's why they're kind of pushing for sooner rather than later. We also need to open the floodgates there.
Michael, when you look at, so the U.S. powering ahead and, the stress test, flying colors, they're paying back dividends. I mean, here in Europe, we're still asking ourselves when we're going to have some cross-border consolidation or even domestic consolidation. And again, today, there's rumors or press reports about Credit Suisse and UBS potentially merging. I mean, does that even make sense?
Well, I think the issue you run into with all of these big bank deals is, and we've seen some of the smaller ones, but on the big ones, there's a lot of reasons against the deal.
Mainly the regulators.
The regulators have become a little more open to this idea, but it does. If you have $1-2 trillion bank in your country, that does raise potential issues. And we have seen some, risk failings at some of these firms. So, just pushing them together to solve that. So there are a lot of questions about some of these big deals, what the synergies would be, how complementary are they? there do seem to be more discussions being had now.
I mean, so your team's doing a fantastic job and also breaking a lot of news with ARCHEGOS and Credit Suisse. On ARCHEGOS, there's also a probe now in the U.S. Where will that go, or how big can it be?
Yeah, so it seems like the Justice Department is, in early stages looking at a lot of things. What we reported was that they are looking at how the banks handled this and some anti-competitive concerns. We had reported that there were talks before some of the sales between the banks of, okay, how do we make this wind down more orderly? Obviously, those talks didn't materialize because it was not very orderly. So, but the DOJ is looking into that.
Michael, thank you so much. Michael Moore there, Bloomberg's finance managing editor for EMEA. Always some banking news, of course, every day. So we'll get more on the banks a little bit later on. Now, China crushed Jack Ma and his fintech rivals maybe next. Later on in the program, we discuss the winners from Beijing's crackdown on its internet monopolies. That's today's big take, and this is Bloomberg. We have a deal. President Biden reaches a bipartisan infrastructure agreement worth over $500 billion. Irish Finance Minister Paschal Donohoe tells this program that he sees a global corporate tax deal in the second half of this year. He says his country is well prepared to change its tax rules. And Wall Street's biggest lenders sail through the Fed's stress tests, setting the stage for bumper bank buyback and dividends. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Friday, the 25th of June. As always, happy Friday. It felt like a shorter week than the previous week, but for those who had a long week, an extra happy Friday for you. Now, for a while, it's felt like the message coming from the Fed was full employment above all else. But after a few hot inflation readings, some of the old thinking about the risk of temporary inflation turning to undesirable higher inflation is back, definitely back. We dig into the Fed speak this week.
The extreme reaction in the Treasury markets after the hawkish surprise at the FOMC meeting last week has investors looking for the Fed to provide some calm. Before coming back a bit this week, the spread between 30-year and 5-year Treasuries plunged to its lowest level since late last year, fully erasing several months of reflationary steepening.
It's easy to say that the Fed should tighten, and I think that they should. But I think you'll see a very sensitive market and a very sensitive economy.
The Fed anticipates 2 interest rate increases by the end of 2023, sooner than many thought, and its message for most of the recovery has been that inflation is transitory, which concerns some.
Much of the consensus of professional economic forecasters in February was that we would have inflation just above 2% this year. We've already had more inflation than that in the first 5 months of the year.
There is a sense that the recent months of data have now activated the inflation-fighting white blood cells at the Fed.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that.
For a while, it felt like the message coming from the Fed was, quote, full employment above all else. But after a few hot inflation readings, some of the old thinking about the risk of temporary inflation turning into undesirable higher inflation has come back. At this week's hearing, Chair Jay Powell seemed to be ready, but is staying on the transitory course for now.
Perhaps all of the overshoot in inflation comes from categories that are directly affected by the reopening of the economy. I will say that these effects have been larger than we expected, and they may turn out to be more persistent than we've expected.
Time will tell if the new Fed will be the same one that raised rates multiple times in 2018, or if it remains more patient throughout the recovery.
Well, joining us now is Janet Moy, a Bruin Dolphin Investment Director. Janet, as always, thank you so much for joining us. So in terms of the inflation debate, it has moved quite a lot. Where do you see the best opportunities? Do you stay away to some of the growth value stocks into a rotation?
Hi, good morning, Francine. Well, we have actually turned a bit more balance on our view on growth versus value and the cyclical stocks. I think the rise in bond yields have happened very quickly in the first quarter. And despite having these very high inflation readings in the U.S. and hawkish surprise coming out from the Federal Reserve, actually bond yields have come back down and growth stocks have rebounded. It suggests to us that actually markets are buying the narrative that inflation is transitory. And indeed, we have seen more incoming data suggesting, if you look at the breakdown of the inflation data, is mostly related to that reopening of the economy and also a transitory factor. So I think the markets are buying that narrative. And we also know, despite the hawkish Fed, actually rates are not going to increase for some time. We're talking about 2023, which is really, quite a long time from here. And it's just projections. It may happen or may not. So I think we are turning a bit more balance on the view on growth versus value, because those cyclical value stocks have bounced very strongly because of the bounce in the bond yields and inflation expectation. But we see that coming back down actually. So we think that going forward, it could be a more balanced market, which in our opinion, the good macro backdrop actually lifts all boats in the market.
Janet, overall, is there something that actually you want to be part of? So if you look at the repricing of the markets because of what we heard from the Fed last week, what's the catalyst for the next leg up for a lot of the equities, for example?
Yeah, well, we think that basically the equity market is going to creep up gradually instead of having a sudden catalyst to have a significant boost. So it's more like a long grinding up market, in our opinion, with potentially some periodic mini pullback from concerns over tightening monetary policies and some other uncertain macro events. So we think that there are still a number of catalysts for the markets going forward. For example, we got the news that there's a bipartisan agreement on part of the infrastructure deal. More could still be in place with regards to U.S. stimulus. And also, we are still having that economic recovery. So we could see more of that coming because, for example, in Europe, the services sector is not fully open yet. The travel restrictions are still in place in many countries. So we have yet to see that materialize in the future. We have yet to see further tightening in the labor market. There's still a lot of uncertainty. And we still have yet to see inflation actually coming back down towards more tolerable levels. So I think these could be the catalysts going forward. But what we think is that it's more a sustained gradual creep up and grinding up of the market rather than, a significant upshot from here.
Janet, what do the stress tests actually mean for your exposure to some of the U.S. banks?
Yes, we think that the U.S. Stress tests, they're very good results. Basically, the average of the bank's capital ratio is twice that of the minimum required stress capital buffer. So that's really good news. It shows that the banks can increase their dividend payout and also their share buyback. So it's all great. So we have been more positive on the cyclical stocks, including the bank stocks, whether you're talking about the U.S. and Europe. So for the U.S. Bank stocks, we think that potentially there could still be more upside because, well, ultimately speaking, despite stabilization in bond yields, we think that we are still early on in the cycle. We are looking for gradual up climb in that bond yield over the next couple of years. So there's still scope for that U.S. Banks to grind up. And we think with the also ongoing more robust U.S. economy, the banks would definitely benefit. But for the European stocks, the bank stocks, they have also rallied. But the scope for that further rally could be less going forward because ultimately Europe is still stuck in negative bond yields, and there's just less scope for that monetary tightening going forward. And the recovery, the structural growth of in Europe, and there's just less animal spirit for the very profitable corporate deals for the bank stocks.
Janet, thank you so much for joining us today. Janet Mui there, Bruin Dolphin Investment Director. Now, coming up, China crushed Jack Ma and his fintech rivals may be next. Later on in the program, we discuss the winners from Beijing's crackdown on its internet monopolies. This is Bloomberg.
Meme stock mania has been all the rage in 2021, and now some are wondering whether meme stocks will bring more volatility to the annual reconstitution of the FTSE Russell indexes. This rebalancing takes place after the close on Friday, June 25th, and it is often a high-volume day as index managers rush to match their portfolios to the composition of the reconstituted indexes. Meme stocks are front and center this year because of the meteoric run-up for the likes of GameStop, AMC, and others on the Reddit rally. But it turns out that not all memes were up equally at the right time. The cutoff date for stocks to be included or removed was May 7th, and the criterion is market cap. As of May 7th, GameStop carried one of the largest market caps in the Russell 2000, having soared by more than 3,700% from its $4 plateau last summer. But for fellow meme stock AMC, not so much, as it will likely stay put. Other likely candidates to be moved to the large cap Russell 1000 from the small cap Russell 2000 are Caesars Entertainment and Penn National Gaming, which had large market caps as well on May 7th. As for whether the reconstitution will bring more volatility than usual, many traders and analysts seem to think not. This has to do with the less than 1% weighting of any stock within the Russell 2000, which means that no one stock has an especially strong influence. And while the 2021 reconstitution of the FTSE Russell indexes may not prove to be a big volatility event, it will likely be a high-volume event as usual. Meme stocks moved or not.
Bloomberg's Abigail Doolittle there looking ahead to the rebalancing of the Russell indices. Now let's get your Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. EU leaders have rejected an appeal from Germany and France to hold formal talks with the Russian President Vladimir Putin, handing Angela Merkel a rare public defeat at what could be her final European summit as Chancellor. Meanwhile, in a heated debate, Dutch Prime Minister Mark Rutte challenged Hungary to leave the European Union as a spat over LGBTQ rights deepened the country's isolation in the bloc. Now, German Economy Minister Peter Altmaier says the US and EU could bridge their trading differences by the end of the year. He spoke to Bloomberg after a meeting with top American trade official Catherine Tai.
When you consider all three aspects, I think it can be possible to find such a solution, and I hope that the next council. By the end of the year? I think it is possible to negotiate it until the end of the year.
And the UK has added Spain's Balearic Islands and Malta onto its quarantine-free green travel list. The government also pledged that rules will be relaxed later in the summer for some countries for those double or vaccinated. However, German Chancellor Angela Merkel urged the rest of the EU to follow Germany in restricting arrivals from Britain and other countries with high rates of the Delta variant. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now, Adevinta has this morning completed its $9.2 billion acquisition of eBay Classifieds. That's after receiving approval from UK and Austrian regulators. The deal creates the world's largest online classifieds group and is the largest acquisition by a Norwegian company in over a decade. Getting the deal over the line, though, was not easy. Both parties pledged to divest some assets, with eBay saying it will offload its UK Gumtree business and Adevinta its Shpock app. I hope I'm saying it correctly. Well, joining us to discuss all of this and to correct me on my pronunciation is Rolf Erik Ristel, the Adevinta Chief Executive. Rolf, thank you so much for joining us. First of all, how much can the business you've just acquired grow? How different will it look like in 5 years from now?
Well, can I just take one step back? And 2 years ago, we did an IPO of Adevinta. At that time, we said we wanted to expand and contribute to the consolidation in the industry. That was only 2 years ago. Now, the eBay Classifieds assets, that was always our dream partner. So when we had the opportunity to participate in the contest for eBay Classifieds assets last year, that was a huge deal for us. And we were so happy that we're able to make it. So with this new company, we are by far the leading online classified company in the world. And I believe that we have very good growth prospects ahead of us, both in the existing Adevinta portfolio and also in the eBay classified assets.
So Rolf, so how do you see the business actually evolving? Where will the most revenue actually come from, and how can you grow it from now?
Well, our biggest markets will be France and Germany, and then we'll also got large positions in important countries like Spain, the Netherlands, and Brazil. And what we're seeing is that the digital economy is, of course, accelerating after the COVID. And since we have digital marketplaces, we believe that consumers are getting used to buying and selling more and more digitally, and we're very well positioned for that. Whether it's consumer goods, whether it's cars, or whether it's doing more of the transaction digital in real estate.
Yeah, Rolf, is there any part of the world where at the moment you're not present, where you see real opportunity? Or do you first of all want to work on the countries where you're present but not 100% mature yet to make sure that you squeeze every inch of revenue there first?
I think the important part for us is really to use now our size and our scale to continue to innovate and develop world-class products. The focus in the shorter term will, of course, be to get the integration right. And we believe that we have a lot of room to growth in the markets that we already are in. Then what we've said is that in the medium term, of course, we'll like to continue to expand and continue in further and be a leader in the further consolidation in our industry.
So you've also had to do some divestments. I mean, are those now fully done? Is there anything else that you would be looking to be putting on the block?
Well, that was as you mentioned, that was part of the regulatory feedback from the UK that we had to divest those assets. Of course, we would like to keep them, but of course we respect that decision. That's now all being taken care of. So that's all in process.
Rolf, give me a sense of what you're expecting the EU antitrust regulators to find in their probe of Facebook's marketplace. This is basically the classified ads.
Well, I think let's see what they find out. I think it's good that they do look into it, and I think the thing that they will probe is whether Facebook is using data they have from other services to boost the classified service. So let's see what they find out. I'm curious to see about that.
All right, thank you so much for your time today. Rolf Erik Ryssdal there, the Adevinta Chief Executive Officer. Now, China crushed Jack Ma and his fintech rivals maybe next. Up next, we discuss the winners from Beijing's crackdown on its internet monopolies. This is our big take, and this is Bloomberg.
I believe that during the year, there will be an agreement reached on this issue. I believe what we will see is a sequence of meetings that lead to a comprehensive agreement in the second half of this year. And yes, the G20 meeting in Venice will be one of those signposts to get into that point.
Well, that was Ireland's Finance Minister, Paschal Donohoe, speaking exclusively to this program earlier on. Now, U.S. Senator Amy Klobuchar spoke with Bloomberg about the need for regulating big tech.
At some point, if there's no competition, these companies are allowed to become these monopolistic, dominant providers. And in the case of AT&T, no one wanted to destroy AT&T. They just wanted to make sure that new competitors can develop, like at the time MCI. It brought long distance rates down. We got the cell phone market to go from one big cell phone that fit in like Gordon Gekko's briefcase in that old movie Wall Street to where we are today. I think we need to look at it the same way. You have got situations where you'll have gateway companies that dominate so that they can literally tell people who want to advertise on them, in the case of Google or Facebook, look, I'm sorry, we're going to charge you for that. We just had a big story on app stores with Apple and Google and found out that they're charging Spotify or Match.com 30% of their revenues that come in, but they don't charge it to other big companies. They get to pick. I just don't think that's how a competitive marketplace works. So I look at it as, I love capitalism, but I always believe that you need to put some guards around it when it comes to ensuring capitalism works.
Now, your antitrust approach would strengthen antitrust legislation across industries. The House is taking a much more specific approach targeted at a handful of the tech companies that we're talking about. You've said you plan to introduce smaller bills as well. Specifically, will you introduce a companion bill to Representative Cicilline's proposal, to Representative Jayapal's proposal?
Yes, we're looking at all of those, and they have already put forth companion bills to some of my proposals, including increasing the merger fees, which has, by the way, been marked up, passed through the committee. We expect that it'll pass through the House because it's already passed through the Senate. That's over $100 million to the agencies to hire lawyers to take on the biggest companies the world has ever known. I am seriously in discussions with the Republicans about a number of their proposals. I think you will see companion bills. They may not be identical, but very similar. I commend Representative Cicilline for what he's done and am very supportive. I think we also need, and I know he does, believe this, to look at other industries as well. So to me, given that we are a small but mighty group that works on this, both Democrats and Republicans, we don't believe there's a monopoly on good ideas when we're dealing with monopolies. We've been very good, including Representative Buck and Senator Lee, about trying to work together on this and finding where we have common ground. And that means tech-specific bills, but it also means broader bills.
Bloomberg's Emily Chang there speaking exclusively with Senator Amy Klobuchar. Now, this is a picture for the markets. There's one thing that really made me laugh actually looking at our Markets Live blog this morning. And it's one of my favorite writers, but one of our great writers, Van Ram, basically saying that it's really a symbol of our times, that the Fed's dot plot delineated a hawkish trajectory, and barely a week later, i.e. today, stocks actually are going or close to set a new record high. Long-end Treasury nominal yields are also turning, if anything, a touch lower. And you can see it playing out in front of our eyes when you look at the Dow Jones future. It's gaining some 0.2%. The Stocks European 600 really pretty much unchanged here in Europe. So we're seeing a lot of markets being steady. Investors weighing the growth outlook following tentative agreement on an American infrastructure plan. Again, our Kathleen Hunter was really debriefing us on this infrastructure plan. It doesn't mean that it's passed, but it does mean that it's kind of heading in the right direction. We also know that the stress tests were successful for certainly the biggest banks. By Bloomberg calculations, that would mean that they could get some $140 billion back. That's not an insignificant number. Oil holding above $73 a barrel. I don't know if we have it in our market check, but actually that's another one that kind of ties nicely off the back of gold. And this is as traders also awaiting deliberations among OPEC plus producers that may lead to a supply hike. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz is off today, so we'll be joined by Danny Berger. This is Bloomberg.
Republicans and this group did not want to go along with many of my family plan issues, the child care tax credits, the human infrastructure that I talk about.
We will get this done. It's a very, very good moment for America.
I love capitalism, but I always believe that you need to put some guards around it when it comes to ensuring capitalism works.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, June 24th. Our top stories today. We have a deal. President Biden reaches a bipartisan infrastructure agreement worth over $500 billion. Wall Street's biggest lenders sail through the Fed stress test, setting the stage for bumper bank buybacks and dividends. And travel troubles, EU leaders at odds over waiving quarantine requirements for those with unapproved vaccines. Well, good morning, everyone, or good afternoon, depending on where you are in the world, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kailey Leinz is off today. Matt, if you look at the markets, and I found this fascinating, I feel like it's Friday.
I feel like I should quiz you on what time it is in many different cities. How many different cities do you know the time to?
I mean, there was a finance minister, actually, of Nigeria who had a watch with like 10 time zones, and I feel like that's what we need if you're anchoring on Bloomberg Surveillance. Matt, if you look at the markets, it's amazing what week, I know you're looking at the markets and the time zones. It's amazing what a difference a week makes, because we're looking at record highs now, but only a week ago we were repricing after the Fed indicated that inflation could be a bit stickier than expected.
Yeah, you're right. In fact, I heard you say we're almost at record highs a few minutes ago. So I looked back through. The S&P 500 is there, but you're right. We're almost there on the MSCI World. We're almost there on the Stock 600s. There are a lot of indexes that still have room to run until they hit their records again. The S&P 500, however, is there, or closed there yesterday, and looks set to rise again today. Let's take a look at Asian markets, because they had a pretty fantastic session. Certainly, we saw big gains in China, big gains in Hong Kong. That helped the MSCI Asia index to rise as well. I think 1% right now. But if you take a look at some of the stocks, you can understand why China did better than the rest of the region. Tencent did really well. Alibaba did really well. And we've got a great Bloomberg big take on the crackdown over the past few months that these companies and these big billionaires that own them have seen. I recommend going to NI Big Take to check that out. You can also see the Korean won. The color is red here because it's dollar won, but the Korean won is rising once again, and it's actually the biggest gainer among the big Asian currencies over the past 5 days, so it's on something of a roll. Danny, what do you see going on in Europe?
Well, you know, South Korea, one of the first central banks to really take up the mantle from the Fed to suggest more tightening. So that might have something to do with that. But we are seeing a pretty dour day in Europe. It's the car makers, some of the more high beta names that are weighing on them, which is why you're seeing Germany down by 0.2%. The standout, though, the big outperformer is the UK. I mean, it's unchanged here, but better than a lot of continental Europe. Part of the reason it's doing better is because of what's happening in the pound. It's a lot of that FX currency effect, which is keeping UK stocks afloat. So looking at the euro pound, we are seeing the pound weaker against the euro. So you're seeing green here, as Matt was explaining before, because this is the euro versus the pound. Some positioning for a hawkish surprise from the BOE. Certainly didn't get it. That said, we're also seeing a UK 2-year yield basically staying put after moving lower yesterday after that rate decision. Also looking at a euro that's just 9 bips stronger versus the dollar. Again, that weaker dollar after the infrastructure bill, that more risk on type of market attitude. And finally, we have Adidas rising nearly 5% after that blowout quarter from Nike. They're seeing their sales very, very high for the entirety of the year, surpassing $50 billion. We're also seeing U.S. futures at a standstill. But if you want to look for gusto, which is what Savita Subramanian from BAML suggested that you do on air on Bloomberg TV yesterday, you're going to find that gusto in the Dow. We're looking at a Dow that's up 76 points so far this morning because of that infrastructure bill. It's those construction companies that are doing well. Meanwhile, a dollar, as I said, is weaker, and we're looking at a U.S. 10-year yield that is unmoved today. Francine, the bond market is just so unimpressed with this deal here. I mean, is it just like the stereotypical bond investor who's always kind of skeptical? Really leaning into that today, I'd say.
Yeah, and it also really feels like it's a political win because the Biden administration can spin it, but it's unclear actually what gets passed. Danny, let's also look at what else is ahead today. There's more U.S. economic data to round out the week. We'll get personal consumption figures at 8:30 a.m. New York time, then University of Michigan sentiment at 10 a.m. It's also been a big week for Fed speakers. We know that. We talk about it every day. We'll have much more today because up first, Minneapolis Fed President Neel Kashkari at 10 a.m. Eastern time, 2:30 p.m. The former Minneapolis police officer Derek Chauvin will be sentenced. Now, it comes after he was found guilty of killing George Floyd. The murder sparked global protest over racism and police violence. Now, back to the infrastructure bill, and we have a deal. President Biden says he's reached an agreement with a group of Democratic and Republican senators on a bipartisan $579 billion infrastructure plan. Joining us now is Kathleen Hunter, our Bloomberg U.S. politics editor. Kathleen, it's not really moving the markets. So what's the likelihood that this actually gets passed in full?
Well, I think that's the thing. We really don't know at this stage. Obviously there was a big show outside the White House yesterday with Joe Biden, being flanked by Republican and Democratic senators, essentially saying this was an important moment for America, a symbol of the ability of Washington folks to still achieve bipartisanship. But at the same time, there's huge hurdles in Congress that remain. Many conservative Republicans are saying they're planning to fight the bill tooth and nail. And on the other side of the coin, you have liberals who are demanding assurances that an even larger spending bill, one that Democrats are looking to ram through without any Republican backing, that will also pass as a precondition of their support. So this is definitely a long way from being done, but I think it's important because it's a political win and a substantive win for Biden. It's been a big focus of his first months in office. And so whether or not it does pass, I think it might be his best chance at getting a bipartisan win. And so I think he's going to continue to tout it, whatever the outcome is here.
Go bipartisan here, but also take everything else you want by force, I think is what this administration wants to do. Bloomberg's Kathleen Hunter there wrapping up what we saw yesterday. Meanwhile, EU leaders meet in Brussels today. They're divided over a number of issues, including travel, with Angela Merkel and Emmanuel Macron expressing alarm at tourism-dependent countries like Greece waiving quarantine rules. Bloomberg's Maria Tadeo joins us now out of Brussels. Maria, what do you got?
Yes, Matt, there's a real focus today on the economy and the virus. There's a real concern among European leaders when it comes to the Delta variant. And that's after a report from the European Health Authority suggested that this is going to become the dominant strain in Europe. And by the end of the summer, 90% of all new cases will be the Delta variant. So European leaders do agree that they need to accelerate the vaccination campaign. By the way, new data today suggesting that by the end of this week, 60% of all Europeans will have had at least one dose of the COVID vaccine. But as you say, there is division as to how many tourists from third countries should be allowed into the European Union. Angela Merkel is extremely careful on this. She does say that the variants need to be kept in check. Having said that, for the southern European countries, the idea to have to close up or restrict access is something that they're not willing to swallow. This is a huge economy or a huge sector for their economies. And they say to some extent, the vaccination campaign is going well. We can live with the variants. We just need to be more careful. But the idea of restricting access is something that they're not willing to accept over the short term.
Maria, how much of the other focus is, of course, on Russia, but how much is it on taxes and whether we're going to get this 15% overall global tax deal?
Well, yes, Francine, you're very right. Russia was also a point of contention yesterday. We know that Angela Merkel was actually, in fact, pushing for this meeting to happen with Vladimir Putin. The idea here, the rationale from the Germans, is that Biden just had a meeting. Russia geographically is in Europe, and you have to engage to some extent while keeping the sanctions on. But we know that didn't happen. The Baltic countries in Europe saying that was just a no-go for them. In terms of the tax, Francine, that will also be a focus in the meeting today. We know there's countries like France, Italy, Germany, Spain, they're all pushing for the G20 agreement in about 3 weeks, but consensus is not fully aligned. This is going to hurt countries like Ireland. We just had the Irish finance minister in your earlier hour. He says we're ready for it, but the reality is behind the scenes for them, this is going to be very hard to swallow. This is their competitive edge, and it could be about to go away.
A fantastic interview, I should say, of Paschal Donohoe. Recommend anyone go watch it. Maria, thank you so much. That's Bloomberg's Maria Tadeo. Now, Wall Street banks easily cleared the Fed's stress test, and now they're poised to announce dividend increases along with stock buybacks. Let's get more with Marcus Ashworth, who joins us. Marcus, okay, we had this pass with flying colors. Now, what do shareholders want to see?
Well, shareholders want to see their share price go up, and their wishes will be granted. Look, the pandemic has actually been a massive windfall for most of the banking industry in the U.S. They came into it pretty strong, much stronger, say, than banks in Europe, and they've done extremely well, funny enough, because the Fed has thrown so much stimulus at them. They all got the memo pretty early on that needed to buy as much risk as possible in the credit space, and they certainly did. Funny enough, they've come out of it even stronger, and now, the restrictions which were in place, rightly so, have fallen away, and they're in a very, very, very strong place. So they're going to go back to buybacks, which is possibly not a great thing, but certainly dividend payments, that's good news. But the only thing I'd say is that there's only one thing worse possibly than a bank with too little capital, is a bank with too much capital. This is going to encourage more risk-taking, which can be good and it will help the economy, but it needs to be a very careful eye on it. And I would say particularly on the stock buyback front, which is not really the great way of going about things when they've had such a windfall that ends up directly benefiting perhaps the executives in charge to quite such a large degree.
Yeah, so definitely a big impact that could be had on the economy. Marcus, thank you so much. And I have to say, you have set me up so perfectly for some pre-market movers. I'm going to do banks, but first I do want to start with Nike, just because it is a monster of a move that we're seeing so far in pre-market trading, up nearly 12%. It's hard to underdo how good their earnings were. $50 billion. They're going to surpass that figure for the first time ever in their annual quarterly earnings. We have sports back. The Euros is on. Everyone obviously buying a Three Lions England jersey because Harry Kane's going to lead them to the win, obviously. So Nike doing very well. But to banks, I know, Matt. I'm just being hopeful. I have to adopt them because I live here now. I have to. Anyway, on to banks. Bank of America, one of the biggest gainers out of the banking space. Marcus was just walking us through that shareholders want to see their price go up. And up they are, at least of this morning, up 1.5% after passing that stress test with flying colors. Finally, I got a SPAC deal for us. This company is going to be buying, not merging with, going to be buying an electric vehicles company. But I have to say, I love this one because its ticker, which you can see over there, is PSAC. It's an anagram of SPAC, and I really am convinced that this is a company that chose their ticker first and then chose their name of Property Solutions Acquisitions, because they're doing nothing in the property space. They're buying an electric car maker. But I think this is one of my nominees for one of my favorite tickers, Fran.
I mean, I just absolutely love that. Wasn't there a story that at some point, like a Zoom, but that wasn't the Zoom that we use for virtual conferences, went up like 500% because of the ticker?
This happens all of the time. You have a company that has kind of a similar ticker to a company that has a good news story. People buy it.
There you go. And some people pay like thousands of dollars for this kind of, investment advice from, you heard it here first. Just choose the right ticker when you list. Coming up next, we talk about tickers and markets with James Bevan, CCLA Chief Investment Officer. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua and Danny Berger in London. Kailey Leinz is off. Now, when we're talking about bulls, we've got one of them coming on to join us in a moment on stocks. He has one of the highest targets for the S&P 500 at 4,600 this year and 4,800 next year. I'm told only Jonathan Golub matches him in that. I've got Dan Curtis, my chart guy back in New York, has put together a little chart for me, but it's pretty simple for those of you listening on London DAB Digital. We welcome you, and I'll just tell you it shows the incredible run that we've seen over the last year in stocks, not deterred, it should be mentioned, by the Fed's hawkish turn. Right now, on the S&P 500, we are at an all-time high of 4266. With that, we welcome James Bevan, CIO at CCLA Investment Management. And James, even though there are concerns about inflation maybe running hotter than the Fed has expected, even though we've had three Fed members come out in the last 24 hours and say rates should rise in 2022, you still have this target that's another 400 points from here, and next year another 600 points. Why are you so bullish?
Well, Matt, to begin with, I absolutely concur with the perspective that we will see higher yields. I think that the 10-year yield on US Treasuries will finish the year at 2%, and I think we'll be at 2.5% this time next year, and higher yields are necessarily part of the normalization of economies and rates. And I think that if we didn't have the Fed intervening and we didn't have buying by Japanese and German investors for whom US yields are eye-wateringly high, we'd have the US 10-year yield at 2.5 at present. And to me, the real driver of equity progress is going to therefore having relatively stable valuations, but superior corporate earnings growth. So I am projecting for the S&P 500 that we will see $200 at least in the current calendar year of earnings, and $215 next year, notwithstanding the expectation that Mr. Biden will be raising taxes, and therefore the corporate number next year will be less than it otherwise could. Now, what's not to like in an environment of reasonable growth, low inflation, and an accommodative policy?
James, what is if you look at the markets, what is the craziest bet that you would make right now? We had a repricing a week ago, and now actually we're near record highs. Is there anything that you would be selling right now?
Well, I absolutely believe that there are parts of the market that are in cloud cuckoo land and one shouldn't touch with a barge pole. So for me, cryptocurrencies are purely a speculation, and prices can fall extremely savagely and likely will when bond yields are higher and economies are normalized. So those sorts of speculative assets I'm not interested in. Equally, I know lots of people are talking about holding gold as a hedge against inflation. I think that is mistaken. As interest rates rise and as economies recover, I think the gold will prove to be thoroughly unpopular. Indeed, I look at the ratio between the gold price and the copper price as one of the reasons why I believe that US 10-year paper should currently be yielding 2.5% were we not to have foreign buying and, of course, the actions of the Fed. But in terms of the detail of the market, I worry that people join the dots on probable demand and automatically assume that it's all going to be good news for people on the supply side. I look at the housing market, for example. Everybody says that's a one-way bet. I think actually the house builders are going to really struggle to deliver the numbers that people are expecting. And this morning we have an awful lot of people talking about Mr. Biden's infrastructure spending. Frankly, the US simply doesn't have the capacity to implement that infrastructure spend. Instead, I think there's going to be a much bigger focus on increasing productivity.
James, what do you mean? What do you mean by that? Why doesn't the U.S. have the capacity to implement this bill?
Simply because there are not enough companies with the capacity to break ground in order to rebuild the infrastructure. What we, I think, have to see are companies with reasonably high margins investing in technology and innovation to offset the wage inflation that is undoubtedly working through the system. Those are the bets that I think wise investors should currently be making, not betting that Mr. Biden is going to be able to press the switch and get the infrastructure money deployed quickly in the U.S. economy.
So, James, but if companies do have to meet up with this demand that's coming out of the U.S., out of the infrastructure bill, are we going to see structurally higher inflation if they do have to adapt and ramp up their output?
I think there is every chance that we see higher inflation for a rather longer period than the Fed has suggested. And I would put a 1/3 probability on the expectation that inflation turns out to be higher and stickier than the Fed proposes. Now, of course, the Fed has a story to make. It wants to keep interest rates low, needs to persuade the market that inflation is going to be low so that inflation expectations are depressed and wage requests and so on are reasonably constrained. I think that that is wrong. I think that the Fed is going to take inflation much more seriously because when all is said and done, inflation is regressive. Inflation hurts people at the bottom end of the economic continuum far more than the top end. And both Mr. Biden and Mr. Powell are very keen to ensure that people at the bottom end of the ladder get a fair crack of the whip.
James, thank you. James Bevan there, Chief Investment Officer at CCLA Investment Management. Now we'll have plenty, of course, on the markets. We'll look at treasuries and gold. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off. Now let's get straight to the Bloomberg First Word News. And one person is dead, with almost 100 people reported unaccounted for after the collapse of a 12-story residential building north of Miami in Florida. The cause of the collapse, affecting about half of the 130 units in the complex, remains unclear. It's been 8 months since Chinese billionaire Jack Ma all but dropped from public view, while his Ant Group has plunged in value by an estimated $70 billion since he openly pushed back against Beijing. Chinese authorities quashed Ant's plans for a blockbuster initial public offering. That crackdown also put pressure on companies from Tencent to JD.com. The winners, while the country's state-backed banks, shares of China merchants banks have soared almost 60% since the IPO was suspended. Coming up, we'll talk a lot more about private equity and markets. This is Bloomberg. This is Bloomberg Surveillance Early Edition, and you're looking at the principal room. Now, coming up later today, U.S. Energy Secretary Jennifer Granholm. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off today. Now, Credit Suisse may seek a merger with UBS as a way out of the quagmire quagmire is a great word, out of the quagmire that it may face if activists take advantage of the bank's involvement in the Greensill and Archegos debacles. Well, joining us now is Bloomberg's Tom Metcalf. Tom, first of all, it's definitely a quagmire, and we've been covering this for many a time. But does a UBS Credit Suisse merger actually make sense? Will it be allowed by regulators if this is what the two banks want?
Yes, well, it's very interesting times for Credit Suisse, and you know, I think that's why this merger, sort of the rumours in the market are starting to pick up, because it does in some ways make sense. I mean, you know, I guess the advantage of it is, you know, it's a big Swiss institution, and you know, obviously merging with their admittedly crosstown rival would keep it within Switzerland. So you'd probably be able to sort of at least alleviate some of those concerns from at least the Swiss regulators. But I think that the sort of, you know, lesson here is what an interesting time it must be for Credit Suisse if rumours like these are sort of swirling. We've seen it, you know, over the past few months with lots of different banks, you know, perhaps poised as partners. And the other thing is just how difficult it is to actually get a big M&A deal like this over the line. I mean, I can't think of one massive one in Europe in recent years, apart from a few in Spain, and that was a much smaller, less complex thing they were trying to do.
Tom, would regulators allow something like this? What does the regulatory environment look like for mergers?
So that's the thing. I mean, I think, you know, a merger of this size would be very closely looked at, not just in Switzerland, but obviously the UK, the US. I mean, you know, would there be any competition left in the wealth management space in Europe? UBS is obviously huge in this space, so is Credit Suisse. So I think it would be a very tough ask. But, you know, equally against that, you know, kind of the rationale for this is building as Credit Suisse continues to struggle with these various scandals and issues it's been having. So, you know, certainly from a share price point of view, it's probably quite tempting, but I would say this is would be a difficult one to achieve.
I want to point out that quagmire in German is Schlampfetze, which is itself, I think, a fantastic word with two M's, Schlampfetze. Schlampfetze. What do investment bankers at...
Matt?
Yes?
I love the German words and the fact that you can just tag on stuff.
Well, I mean, quagmire is pretty good for an English word, but yeah, German words are usually much better. Tom, I want to ask what investment bankers at Credit Suisse have to look forward to. I mean, if you're in IB at Credit Suisse, are you hoping for a merger because it saves your unit, your ancillary unit? Are you looking for jobs at other banks? They didn't do badly, right? They're 7 or 8 in the league tables this year.
Yeah, but our understanding is morale is pretty much rock bottom there at the moment. So you've seen a lot of frontline roles leave. I think yesterday my colleagues had a story that something like 50 frontline roles in the investment bank have left in recent months. And you know, there's this story that the new chairman, you know, the former Lloyds CEO, has come in and basically made it pretty clear the investment bank is, you know, sort of secondary or ancillary to what he views as the sort of Credit Suisse's future, the wealth management unit. So, yeah, we're hearing a lot of sort of exits, and, you know, this speculation probably only is likely to increase that. You know, you sort of want to be at a bank looking to acquire, not sort of merge as sort of an act of desperation.
Tom, thank you so much. Tom Metcalf there with the very latest on the banks. Meanwhile, Matt is actually going to give me some really cool phrases to say in German. Coming up, a focus on LGBTQ inclusion in finance this Pride Month. We'll bring you some of our conversation with the LSE Chief Executive, Julia Hoggett, about her own experiences of coming out into the office. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Danny Berger in London, Matt Miller in Berlin. Kailey Leinz is off today. Now, President Biden is speaking later about LGBTQ rights, and it's Pride Month, and we're taking some time to focus on the progress made and the challenges ahead for inclusion in finance. Earlier this month, we spoke to Julia Hoggett, the Chief Executive Officer of the London Stock Exchange, about her first-hand experience.
I became an investment banker in the 90s at a time when it was still legal to sack people for being gay in the UK. And I already knew at that stage that I was. And I remember swiping myself through the barrier on the second day after I'd got my ID card and thinking, I leave the real me on the outside and I pick her up on the way home. So I had this absolute sense of exactly that separation that Tina's talking about. And then you realize you spend so much of your life at the office. Colleagues trust you with information, and you're not sharing an equivalent amount of information with them. And there becomes an iniquity of trust, actually. And that felt increasingly uncomfortable. But I was actually invited to come out by my MD. I had had some surgery. I was in hospital. She very kindly came to visit me. And whilst I was dosed up on morphine, I introduced her to my partner. And about 3 days later, when the morphine wore off, I suddenly realized I'd outed myself at the office. And she came to visit me for my end-of-year review, and at a time when investment banking structures of progression were very clearly yearly delineated, and said, we think we may be promoting you a year early, but very great congratulations. But if you are promoted to associate, we're going to evaluate you not just on what you do for the team, but what you do for the wider organization. And then she took a perfectly timed beat, and she said, have you thought about joining the LGBT Society? Now, I can be dense on occasions, but I'm not that dense. And that was a gold-plated invitation to come out and to participate in the society of the organization, and to do so with my management's blessing. So I then did. I took that lead, organized one of the first ever LGBT dedicated recruiting events in the city. And from that point on, have effectively had a platform to talk about these things.
Well, that was part of our conversation with the LSE Chief Executive, Julia Hoggett, and Deutsche Bank's UK and Ireland Chief Executive, Tina Lee. I have to say, one of the most touching and, you know, interesting and difficult interviews actually to listen to. So many thanks to Julia Hoggett. Now let's take a look at what else we're watching today. I know a lot of the focus, Danny, is on U.S. economic data out later today.
Yeah, certainly. And it's likely we get more volatile markets because we're trying to figure out where the Fed stands. This data, of course, matters a lot. And it's their preferred measure of inflation that we get at 8:30 a.m. in New York today. That's the core PCE. A lot of the components have already come out, so we know this is going to be strong. I think the more interesting thing is going to be the UMich survey, University of Michigan, to see if those in the survey see inflation, because, of course, that means it's becoming ingrained in consumer psychology. So, Matt, we want to know if inflation, if it's coming in fast and furious.
Oh, I like that transition.
Yep.
Yeah, Fast and Furious 9 comes out today. I believe it's already hit the theaters in New York, although it's probably a little early to go to the movies. I'm not a huge fan of the Fast and Furious series. I did once sit behind Vin Diesel at the Victoria's Secret fashion show, but I do love, everyone knows how much I love The Rock and how much I love cars and how much I love going to the movies. It'll be interesting to see as America gets out of lockdown how many people go to the theaters, because this is really the first gigantic summer blockbuster, and we'll have to see if AMCs are overcrowded, Francine.
Yeah, I'm looking forward. Maybe we have the figures as soon as Monday. Now, what I'm watching is, of course, Matt Hancock. He's a health secretary here in the UK. He's in a spot of trouble because there was a tabloid
Rather be a gold
coming out
bug
this morning with pictures, the newspaper actually publishing 2 photos of Mr. Hancock embracing his aide. So he is said to be having an affair with a very close aide. Again,
They're
the
making
health
out.
minister has come under extreme pressure. Also, a couple
They
of
weren't just
weeks ago,
embracing.
after Dominic Cummings, it's British. It's the British way of saying they were snogging. I don't know, if the Americans
I think snogging
understand
is
the
the
word
British
snogging.
way of saying that. Yes.
There you go. Embracing, enamored, whatever you want to call it. The pictures kind of speak for themselves, and we'll see whether the UK government sticks to this cabinet, whether they put their weight and support the health secretary, or whether there could be a replacement. Coming up, more on that story, more on the markets with Don Rissmiller, Stratagas Research Chief Economist. This is Bloomberg.